there is apparently a rate cut. It may be recalled in the statement, data development. Okay.
Where is slashing it actually? RBI cuts the repo rates by 25 basis points.
Yeah, reduce the policy rate to 7.5, keeps the cash reserve ratio unchanged. The other things have not changed. But this is big stuff, Sudarshan. Well, what is the justification for this? It may be recalled in the statement on the monetary policy that key to further easing are data that confirm disinflationary process. Also critical would be the high-quality fiscal consolidation. While maintaining the interest rate stance, the Reserve Bank had said this. The Reserve Bank indicated that it will be keen to monitor the revision in the CPI. And, well, the new CPI released was 5.1% as measured by the new index. Prices of vegetables declined hearteningly. Food declined. So, really, they are pushing it partly on the CPI. And perhaps more significant influences on the near-term inflation will be the strength of aggregate demand relative to available capacity. Two recent developments pertaining to demand-supply balance are the GDP estimates and the union budget. The CSO is to be commended on the changes it made. Okay, they have bought the CSO's number. The fiscal impulses in the budget assume importance. We should be shortly getting some bankers and bond dealers to comment on this. But it's quite clearly both CPI and the fiscal impulses in the budget that are being mentioned as reasons. So while a lot of economists may be unhappy with the quality of fiscal deficit and the number itself, the Reserve Bank clearly says that it is happy. In the the fiscal impulses in the budget assume importance. There are many important and valuable structural reforms embedded in the budget which will help to improve supplies over the medium term. In the short run, however, the postponement of fiscal consolidation to the 3% target by 1 year will add to aggregate demand. At a time of accelerating economic recovery, this is a source of concern from the standpoint of aggregate demand, especially with large borrowings intended for public sector enterprises. Some factors mitigate the concern. Okay, the government has emphasized the desire to clean up legacy issues, which gave a misleading picture of the true extent of fiscal rectitude, and has also moderated the optimism in its projections. To this extent, the true quantum of fiscal consolidation may be higher than the headline numbers. Okay, the reference is that they've only taken 11% as GDP growth. So, you know, it's a truer picture. Last time the assumption was 13.4%. So the Reserve Bank's argument is that the government has emphasized the desire to clean up legacy issues, give a clear picture of fiscal rectitude, and hence, so it's really, they believe the fiscal deficit effort is very good. As well, there is, improvement in the CPI. Let's get an immediate reaction. Someone who is a close India watcher, Adrian Mowat, is joining us from JP Morgan. Adrian, does this mean that you are going to come in and buy one more rate cut from the Reserve Bank, unscheduled one?
Look, I think this will surprise the market. I've had quite a lot of discussions with clients since the budget that does the budget having a larger fiscal deficit of 3.9% mean that the RBI would delay the next reduction in interest rates? You know, the logic behind that, if you've got more of the fiscal stimulus, maybe you get less of the monetary stimulus. So I think this is a positive surprise, and it will make people buy the market, and we can see the market tracking, higher, I think, quite easily on the back of what's happened here.
Okay. Well, actually, the RBI in its last paragraph is justifying why it has done, what it has done, when it has done. It says the need to act outside the policy review cycle is prompted by, first, that the next bi-monthly policy statement is only on April 7th, and the still weak state of certain sectors of the economy, as well as the global trend towards easing, suggests that any policy action should be anticipatory. One, sufficient data support the policy stance. So probably the Chinese cut is also being adduced as a reason, and of course the weak state of the economy. Second, with the release of the agreement on the monetary policy agreement, it is appropriate for the Reserve Bank to offer guidance on how it will implement the mandate. Going forward, the RBI will seek to bring inflation to the midpoint of the band of 4 plus or minus 2, which means it will try to move towards 5%. and that is to 4% by the end of a 2-year period. The guidance on, at the end of the 2-year period, it will try to bring the inflation to 4%. So that goal still remains. So perhaps cut today, but we will start moving towards the 4% mark come FY17. Adrian, what are you expecting by way of further action from the Reserve Bank?
Sorry, maybe just to follow on to some comments on what the Reserve Bank statement is saying. If you think about, they've had a fiscal stimulus in the budget, and it's also important for this economy to get the confirmation that the central bank is behind faster growth as well. So I think this 1-2 punch, or maybe that's the wrong way of putting it, but 1-2 policy of both fiscal and monetary is what we need for business and consumer confidence. And I think it does make a lot of sense if the next policy meeting is as far out as April, that we need to move now. And the test on this ultimately is going to be, do you see a pickup in PMIs, industrial production, two-wheeler sales, four-wheeler sales? Because the activity in the Indian economy, the anecdotal evidence is still that activity is muted.
Okay. I can give you the guidance paragraph as well, and that may be important to make up your mind on future rate cuts. The guidance on policy action given in the monetary policy statement of December is largely unchanged. The further monetary actions will be conditioned by incoming data, especially on the ease of supply constraints, improved availability of key inputs like power, land, minerals and infrastructure, continuing progress on high-quality fiscal consolidation, the pass-through of past rate cuts into lending rates, and the monsoon outturn developments in the international environment.
Also, Lata, this point about inflation, where the RBI says that going forward, the RBI will seek to bring the inflation rate to a midpoint of the band of 4% plus or minus 2 provided for the agreement. So 4% by the end of 2 years, by the time FY17 comes to an end. So that's another statement that's coming in. But Adrian, this morning the SGX Nifty has spiked up considerably. In fact, it's now up almost 1.2%. So expect a big bang opening. In terms of where you would increase your allocation, would you go heavy on the rate sensitives now, i.e. the banks, the autos, etc.? How do you position yourself for this announcement?
I think you do as you say, you go long the rate sensitives. But I think in stating that, we were already long cyclicals in India because over the weekend we got a fiscal stimulus. I think it keeps us overweight a market, and it keeps us with a cyclical bias in our positioning in the market. The first opening statement is this is a positive surprise, and I think the market will be, as you said, with the futures index, it's up sharply. In the conversations I was having with clients, people felt that the risk was there was going to be a delay in the next move from the RBI. So this is good news, and the rally in the Indian market continues. And ironically, if you look at what's happening in China, there's a lot less belief around policy in China, and we continue to see Chinese markets suffering. Even though we did get a rate cut over the weekend in China.
Okay, so now you go even into PSU banks, and do you think today it has it in the market to take the Sensex to 30,000? I think that we're going in that direction. I'm not going to give an index forecast. But with the question on PSU banks, our answer to this has been very consistent, that we like banks with a strong deposit-taking franchise. We do expect demand for credit to pick up, and that'll give an advantage for those that, have the bigger deposit bases. Okay. Adrian, just hold on to that thought. We have someone from India Inc. also joining us, the CFO of M&M, Mr. Parthasarathy. Mr. Parthasarathy, your first reactions, you think now the cost of money definitely falls? Do you expect more demand for your vehicles?
Yeah, it's a very good move and a very prompt move. RBI has acted to the budget and the fiscal consolidation with speed and decisiveness, and that's very good news. And yes, the cost of financing should certainly see a fall in the market, compensate with the fall that has been suggested by RBI.
Okay. Would you say that now you would change your pickup, your sales forecasts? You think that there could be a pickup in sales?
Clearly, any move in cut in our repo rates and cut in rates have been saying will have an overall impact in growth. It takes a little bit time to percolate, but this will certainly be in the positive direction for revival of a good growth phase in auto segment. There will be other things which needs to be done, but this is a step in the right direction, and which will be directionally right for sales.
All right, a step in the right direction, Mr. Parthasarathy. Thanks for joining us. Let's get an economist now. Shubhda Rao, Chief Economist at Yes Bank, joins in as well. Shubhda, hi, good morning. It's been a big surprise morning for us with this rate cut that has come in. What are your initial thoughts?
Yes, definitely a surprise in terms of the timing, but we were anticipating, given the recent deceleration in growth momentum as was observed on yesterday's data on core and also on the PMI survey, last 2 months survey does seem to suggest that there has been a deceleration in the pickup of growth, which was anticipated. So RBI probably has, getting some comfort in terms of internals of the budget making, has had the timing in terms of easing the rates. But more importantly, I think even the inflation momentum probably gives them a larger comfort, because in our simulation, we see a 60 basis point of undershooting of the inflation for the Jan 16 number. And with that, if oil prices do indeed get ranged somewhere between 60-65, I would think that there is a fair degree of chance of inflation undershooting.
Yeah, 1 minute, Shubhda, we have the man who should be acting on this, Pradeep Kumar, the Managing Director of SBI. Mr. Pradeep Kumar, 2 cuts from the Reserve Bank of India. Will now the bankers move? Will we see some fall in base rates?
I don't know. We'll have to, our Asset Liability Management Committee will perhaps meet later in the week and take a call. Okay.
But what's your reaction to the cut itself? Do you think it pushes down?
I think they're acting in tandem with the fiscal. There have been some fiscal incentives in the budget for growth, and perhaps acting in tandem with the government. The RBI has reduced the repo rate.
Okay. Do you not see this as any pressure coming in from the government to act, Mr. Pradeep Kumar? Because, the fiscal deficit targets have been relaxed, and there was an expectation that the RBI would delay the rate cut because of that.
There is no pressure from the government. We take an independent call on all the rates.
So you expect first deposit rates to fall now?
Yes, see, any cut in repo rate should automatically trigger a cut in deposit rates. In SBI, we have already cut the 1 to 3 year, which is the bucket which has the highest deposits, by already 50 basis points in the last, I think starting from September, two cuts of 25 basis points each we have cut. We are below the market. I think most banks are at least 25 basis points ahead of us. So we'll take a call. The Asset Liability Management Group will take a call on what to do with the deposit rates also.
Okay, you think you should get a decision in a week?
Yeah, hopefully.
All right. Thank you. Thank you very much, Mr. Pradeep Kumar.
Right.
Gautam Chowcharia, the head of India Research at UBS, is also with us. Gautam, 30,000 today?
I don't know about that, but markets obviously will react positively to this.
Okay, but how do you react? How are you changing your sector mix or your even attitude or view of the index?
Not really. In our thesis of growth surprising negatively over the next couple of quarters, while inflation interest rates surprising positively, that still holds true. And this rate cut kind of supports that thesis, that the RBI also is thinking similarly. And that should be positive for financials. Financials remains the biggest overweight for us.
Okay. We have Adrian Mowat still with us, so let's go back to him. Adrian, fiscal and monetary easing coming together, of course, is great news for the markets. But what have you noticed in terms of demand increasing on the ground since the last rate cut? And do you see these 2 rate cuts put together having any positive impact on consumer sentiment?
Yeah, I think the problem is that we're still struggling to identify anecdotal evidence of a pickup in India. We're somewhat constrained in the data we can look at. We've got car sale data, two-wheeler data. So I suppose sequentially it looks okay, but the year-on-year growth rate is still low. The IP number is still sub 2%. And we had a tick down in the manufacturing PMI, which included new orders and output in the January data. So we're yet to see the numbers coming through.
Okay. Does this give you a sense that the Reserve Bank is on the front foot in terms of cutting rates? The governor has been an inflation hawk for the better part of 2014. Now, does it look like, he clearly is getting converted? And probably because the promise is that inflation should remain below 6% up until Jan, he could probably move faster. How many rate cuts are you expecting, actually?
So I think we're at the drawing board, a bit like the conversation you were having with the SBI managing director.
Yes.
We're obviously going to review our forecast based upon what's just happened here. We were expecting something in April before this happened, so let's not prejudge what our new forecast is going to be. I think let's not also describe the RBI governor as an inflation hawk. I think he's very balanced. His priority when he came to office was to regain credibility, and part of that was to be more hawkish in his bias. But remember, when he came to office, we were in the middle of the tapering scare. You now have an environment where the priority is moving on to growth as inflation moderates. So, I'm very comfortable with the policy approach that we're getting out of the Reserve Bank of India.
Okay. No, I didn't say I consider him an inflation hawk. I said the perception was of an inflation hawk. Does the perception of the Reserve Bank change, Gautam? Will that move markets?
This will be a much more reinforcing signal in terms of people who had doubts that the rate cycle is going to happen. We didn't, but parts of the market were worried that the RBI may not be as much on the rate cycle in terms of cutting rates by 75 basis points, 100 basis points through the year. So this will give confidence that this is a secular trend and not just a one-off.
Okay.
So definitely.
Yeah, so definitely, sorry, go ahead.
So definitely it will be a positive, taken positively by that part of the market, and therefore the markets will react positively.
Okay, today's, I guess, the bump up that PSU banks and the banking sector will get in general, NBFCs, is a given, you think? Because I think, clearly the 10-year will open very close to 7.5. Wouldn't in itself that be enough for algo traders to push up banks and NBFCs?
So banks will definitely be a big beneficiary. NBFCs definitely, even SOE banks will benefit this. And not just bond book gains. Bond book gains obviously will be a big positive. But one has to remember that lower interest rates will flow through to some level of NPLs coming down.
Okay, I just want to read one more paragraph where the governor speaks very clearly about the quality of fiscal deficit, and there may be an argument there. He says what mitigates the concern about the fiscal target being pushed back is the following. The government has emphasized its desire to clean up legacy issues which used to give a misleading picture of the exact extent of fiscal rectitude. And therefore, these projections, he goes on to argue, are more reliable. The true quantum of fiscal consolidation will actually be higher than the headline numbers. And that partly is also because the government is transferring a lot of money to the states. So that little bit, our fiscal deficit total was 6.5%, with 4% coming from the center and 1.5%, almost 1.4 coming from the states. The states deficit is expected to decline because of the transfer of resources. So the overall state central fiscal deficit could well decline faster than was originally estimated, which he thinks will in itself be an antidote, a counter to any increase in aggregate demand. Furthermore, of course, there are low energy prices which have not been passed on and which have instead been used to boost infrastructure. I mean, we're all cribbing about the 3 rupee rise in petrol. Yeah. So clearly the money is being used for infrastructure and not being passed on to consumption and increasing aggregate demand. So, and finally, the third big reason, of course, is the signing of that memorandum, which ties the government to the Reserve Bank's objectives. So the government intends to compensate for the delay in fiscal consolidation with a commitment to improvement in the quality of adjustment. And that seems to have turned the tide.
But Gautam, I just wanted to come to you on that. Apart from the pure play interest rate sensitives, would you also increase allocation to infrastructure, power, etc.?
So that sector will also benefit ultimately, but it's a question of time frame investors are looking at, because that sector will take time for benefits to play through. It won't happen immediately or overnight. So investors have to take a much more longer term view on those sectors, given the gestation cycle of projects which are there in that.
Back home, back in your office, do you expect you all will re-look at any targets at all, Gautam? Advance any of your, Sensex or Nifty targets, or change your sectoral mix in any fashion?
So we keep looking at it, but I can't predict what we'll do. But as of now, this is not really a surprise to us.
Okay.
A little bit on the timing side, but the direction and trajectory, not really.
All right, Gautam, we'll let you go back and discuss with your staff about what your sectoral mix will be. Today's sectoral mix is going to be state-owned banks, state-owned banks, state-owned banks. PNB opened 6.4% higher, Bank of Baroda 4.2 higher, SBI 3.3 higher, Axis 3 higher, ICICI Bank 2.7 higher, IndusInd 1.8. There are others also who are rising. JSPN is up 4.5%. These are pre-opening rates. M&M is up nearly 3%. DLF is up about 2.5%. That's interest rate sensitives is what I'm reading. Tata Motors is up 1.7%, could be for other reasons as well. And Kane, of course, for other reasons, is up 1.5%. Apparently, its production sharing contract, according to the Financial Express, is likely to be extended by 10 years. But let's get...
No, Lata, before that, I wanted to come to you on your own view of what the RBI governor has done. Because, we've been debating this ever since the budget as to perhaps this may not be the best time to come and cut rates because of how the fiscal deficit targets have been relaxed. But after the viewpoint in this note, do you think it's justified?
No, it still comes as a nasty jar to me, because obviously optically the number was not adhered to. But maybe there is an argument in the sense that overall fiscal deficit is likely to come down. So that might be a point that, to that extent, the number is better met. As well, they've believed that the quality of fiscal deficit is better, because over the past few years, we saw a lot of money, getting just unpaid bills getting poured over to the next year. So maybe that is not there in this case. What the number is, what you got is what you saw. The number you see is what is the correct number. Also, there's no overestimation of the GDP growth itself. I buy that point, but I'm not quite sure that this budget does not, gives a very, very clear picture, because, they're going to increase their contingent liabilities. If they put 20,000 crores into a seed fund and raise loans on that 20,000 crores, you're actually increasing the liabilities for the central government. Only it's kept off the fisc. So to that extent, you can squabble with the RBI's idea. But there's one nugget over there, that 20,000 crores is not provided for in the budget. I went through every entry, there was no 20,000 crores. So they're going to try to find the money for that infrastructure fund. In any case, experts are joining us. Anant Narayan, Head of Financial Markets, Standard Chartered Bank. Sandeep Shenoy of Pioneer is also with us. Anant, where's the 10-year headed now, and your basic comment on what you heard, the unexpected rate cut?
Well, it's a welcome surprise, Lata. The market is very, very happy, obviously. We've seen a 10 basis point rally in the benchmark bond already, so it's headed towards 765 and below. This was a clear positive surprise. I guess after the budget, we were all expecting that the RBI would have issues with the quality of the fisc adjustment. Clearly not the case. RBI has accepted the argument that even though its intent, the direction is right. Inflation, anyway, we are all aware, is heading down below the RBI target. The only third point I would add is I think the rupee itself and the currency markets have had a role to play as well, as the statement from the governor also mentioned. The fact is the interest rate differentials are still very, very high in favor of the rupee. We have seen incessant flows coming into the market. To that extent, bringing down rates in rupee, to some extent at least, does make sense.
Oh, it makes sense, but it is not working out that way at this point in time, Anant. If anything, the rupee has gotten stronger today. For some time now, I think rate cuts will actually result in the strengthening of the rupee because it will be seen as economy positive, or at least it's being seen at this point in time. That argument somehow doesn't wash at this point in time. Interest rate differentials is not the sole reason why flows come in at all. If that was the case, which interest rate would you compare yourself with? Okay, in any case, at the moment, the bond yields have come at 7.64. So that's, I think, what, a 10 basis point fall in the yields. I think they closed at 7.75. You see further falls, Anand?
Look, the next question would be what happens in the April 7th policy as well, right? Everybody was expecting the cut then rather than now. From the document itself, I'm not sure really. Because it has a lot of, it's almost a reluctant cut, to be honest. It puts a lot of question marks about inflation.
Yep.
It puts question marks about the fisc. So one doesn't know whether this was a preemptive cut for the April 7th policy or whether there's a follow-up cut which will happen in April as well.
That's an excellent observation. It certainly looks like a reluctant cut or at least an argument that is labored. As well, statements used to begin with the rate cut first and then the justification. Here, the rate cut is at the end of the page with a lot of justification, coming in front of the rate cut. So at some level,
there's some pressure that has been put, right?
Well, it looks certainly that there could be. I mean, you could read it that way for sure. Say on Anant, MS Raghavan, the chairman manager of IDBI Bank, has also joined in. Mr. Raghavan, what do you see now, an imminent base rate cut? Oh, we just lost him. We'll get back. Sandeep Shenoy, welcome and thank you for your patience. What's your first reaction? You think the markets are going to take it very positively?
Well, I think definitely they will take it because we had exhausted most of the other triggers for the market. The results were out, the number season had come to an end, and even the budget had played its part. I think this is going to ensure that the next round of capital flows to our equity market is going to be there at least for a couple of more weeks. So in that way, it's good for our markets, that's the equity markets, and we could see the new high, which I think is just round the corner, the new high being maintained for quite a few more days.
Yeah, I think we must now start looking at all the festivals. First one came in Sankrant. The second one comes ahead of Holi. So maybe we should wait for the next festival and expect the governor to move.
I think we have Mr. MS Raghavan, the chairman and managing director of IDBI Bank, who also joins in to give us his view. Mr. Raghavan, your initial take on the RBI coming out with a surprise rate cut, and also how much more do you think deposit rates will fall here on?
See, this was, number one, it's a very good news for the industry and the economy. Number two, it was not totally unexpected. It was expected. The industry was expecting a rate cut. Even the bankers were expecting a rate cut. But it has come probably an hour early. But one important thing is another at least about 75 basis throughout the year we expected. 25 has come. So 50 more basis we can expect by the end of the year.
Yeah, okay. If that is the case, what are you all going to do, bankers, Mr. Raghavan? The first cut did not elicit any base rate cuts from any of you, though some deposit rate cuts did come. Now how will it be? You're also standing on the threshold of the slack season.
Absolutely. You all know, Lata, the effect is felt with a lag in the balance sheet of the banks, in as much as the asset side is floating, while liability side is fixed. Because of this anomaly, it translates into the real cut into the balance sheet of the banks with a lag.
Yeah, but that lag has happened. You will have to admit your first deposit cuts were coming in October. It's 6 months now. Many of your high-priced deposits would have matured, wouldn't they? I mean, I'm just asking you, when will the base rate cut come from the banking sector?
Soon. We should sit down in our ALCO and discuss it in detail. Probably it should come very soon.
Okay. And do you think that will relieve any stress on your balance sheet as interest rates start falling? Will there be some people who may have gone over the line coming back because rates have fallen a bit?
The rate cut will mean more to the economy, so the activity will pick up, the credit offtake will pick up. Probably even though there will be an effective cut in the income, it will get adjusted by the increased volume.
Your bank quarterly numbers will definitely show a better other income, isn't it? Because investment bond book will look good.
Absolutely, definitely. There definitely are the yields softening. There will be good, harvest in the treasury side.
All right, Mr. Raghavan, we'll let you go on that note. Thank you for joining us. By the way, pre-opening levels have settled with 300-point gain on the Sensex and 112-point gain. So it could be a big move in trade today. And 30,000 might be here. Yeah, 30,000 might be here this morning itself. So let's get Sanjay Dutt into our conversation as well. Sanjay, of course, we can argue, till the cows go home about whether it's a preemptive cut, whether there's been pressure from the government. But give and take everything, fiscal and monetary easing, big thumbs up for the markets?
I think extremely positive, and without getting into the arguments they correctly said, one thing that's coming across very clearly that contrary to what the public belief or general belief is that both the RBI and the government, that the finance ministry are completely in sync. The budgetary, the announcements in the budget, which are extremely medium-term positive, along with this rate cut to spur growth, are important signals for investment and growth, to investment cycle in particular to start to pick up. Give banks a lot of leeway, a lot of room to sort out the problems that they're living with.
Sure.
I think they're very positive for the market, no doubt.
Now, what are the pockets you would buy this morning itself?
I think focus would continue to be on macroeconomy, on inward-looking sectors. That's things like infrastructure, capital goods, engineering, those kind of businesses, because we would start to see a pickup in the investment cycle, if not immediately, but at least in the second half of this calendar year, which would be positive for all these sectors, including the banks.
Okay. Vikram Limaye is with us, the MD and CEO of IDFC. Vikram, good morning. You see rates falling soon, and do you think you're going to see this rally now continue all the way beyond 30,000?
I don't know whether you can hear me because I'm on the road.
We can.
Okay. So I think I think the rate cut is obviously a positive, and it is something that people have been expecting, not in terms of timing, but during the course of the year, at least a 50 to 75 basis points cut, based on what the Reserve Bank has outlined as its policy of maintaining a certain level of real interest rates. And this is obviously an indication of two things. One, some level of confidence that the RBI has in the overall macroeconomic and fiscal situation based on what has been outlined in the budget. And secondly, a view on inflation, which they believe has stabilized at a
Vikram, do rates fall now? Because you guys have not been cutting base rates, in your case, lending rates. Yeah.
That was the other point I was going to make. So while the Reserve Bank has cut rates, it remains to be seen whether this gets transmitted in terms of lower base rates, etc. in the market. It clearly will benefit people who are targeting the bond market from a fundraising perspective, because that will have an immediate impact in terms of rates at which people are able to raise debt from the bond market. But the transmission from the bank market is still to be seen.
Okay.